I'd like to give you some introductory information about currencies and currency exchanges, also the currency policies that various nations have. Let's get started. First thing to go over is strong versus weak. What do you want to be, strong or weak? If you said strong, you are right some of the time. If you said weak, you're right some of the time as well. It depends on who you are. Often students notice that, well, the US dollar is trading at 1 to like 1300 South Korean won, or the US dollar is trading at 1 to something like 0.95 euros. So the euro is stronger in that case than the dollar. And they ask, does that mean Korea's in trouble? Well, you actually have to have more information to know that, because the South Korean won has for a long time traded at, thousands or hundreds to one. The Japanese yen traditionally, since I've tracked it, has been between maybe 80 and 150 or so to the US dollar. You have to see trends over time. But if you're talking like over a period of time and one is getting weaker or getting stronger, the effects are very different. You want a strong currency if you're going to use your currency to purchase things in other countries, because you get more buying power. You want a weak currency if you're exporting currencies to other places. Let me give you an example of this one. It's a little bit harder to grasp. You're manufacturing something, let's say, in the United States, and you're going to sell overseas. All your inputs are going to be costs that you have to pay. You're going to pay labor with the US dollar. You're going to buy materials with the US dollar. You're going to pay rent in the US dollar, pay taxes in the US dollar. All of those things, if your currency is weak, when you make a product, you're going to be bringing in stronger currency to make up for the fact that your currency is weak. However, if you're an importer and you want to bring in goods and then resell them, you would prefer your currency to be strong. Let the weak money be purchasing the labor, the rent, the taxes, all that stuff, and let it come in, and then you can sell it with a strong dollar. It gives you an advantage that way. Another good example to give you on both of these is if you're traveling. If you're going from the US with a strong dollar to a weak currency or relatively weak currency, foreign country, you are at an advantage because your dollar will go further. However, if the US dollar is weak relative to another currency, then you will be at a disadvantage because it takes more of your US dollars to buy the stuff in the foreign country when you're visiting. But again, having a strong currency doesn't just mean your one unit of currency buys thousands of another currency. It really, you have to look at over time and relative to more recently, is it getting stronger or weaker? Let's switch to a macroeconomic perspective now. There are three primary currency strategies used by countries that print their own currency. They are free-floating exchange, a soft peg, and a hard peg. Free-floating exchange is just a market solution. We're going to demonstrate it in a little bit, but you're basically letting the market of people trying to sell one currency for another or buy one currency with another, you're letting the market determine the price. This is the gold standard as far as advanced industrialized countries that do well economically. You tend to move towards this. It tends to kind of balance out things in the economy. There are economic benefits for being here. But some countries, and for good reason, choose another one of these strategies. Let's do the total opposite of a free-floating exchange and go first to hard peg. Hard peg is when your strategy is you're going to peg your currency to another dollar. That doesn't necessarily mean at parity. For a long time, the Chinese hard pegged their their yuan to the US dollar, and it was at a 1 to 9.13. This was a long time in like the late 90s and early 2000s. They were pegged at that. So it doesn't mean 1 to 1. It means at some point you have a 9.13 and you decide to just keep it there. You peg it to some other currency. Most often the US dollar, could be something else. And you use government policy, which I'll describe later, in order to keep your exchange rate right where it would be. Now, that's not as good as far as the free market, but why would you want to do that? Well, let's say in that time when China is developing rapidly, they have a growing industrial sector and they export goods to other countries. If they're holding their currency there, not letting this number to fall, which means their currency is getting stronger, buying more US dollars for the yuan, what happens is you keep it there, so you keep your currency cheap relative to a country you're trading a lot with, and it makes your industrial goods, your exports cheaper, and it might help your economy grow faster. This is a strategy often used for growing economies, economies that are smaller or economies that are tied to another economy in a big way. It's an easy way to kind of create stability so that trade can happen, and it may bring benefits to that particular country as they are growing. So we have on this end, you totally let the market decide. Here, the government sets a limit to where the exchange rate is going to go. And in between, we have soft peg. Soft peg is kind of where there's a range at which the policy will allow it to free float. But if it goes too strong or too weak compared to another currency, the government of that country will intervene and then make sure it stays within that range. I have an interesting anecdote about this. The first 2 years I had taught in China was from 2009 to 2011, and they had a government-run news service in English, and I would watch it, and the evening news every night would broadcast, tomorrow the yuan will trade between 6.8 and 6.9 versus the US dollar. They would say that every night, and how would they know that it's going to, in the future, be within a narrow band? Well, that's because they were really a hard peg of sorts, but and the history there is they were on this 1 to 9.13 peg. They went off it and did a peg to a basket of currencies, not just the US dollar. And so really it was kind of a soft peg policy. They were kind of floating around. Then the 2008 financial crisis came and they pegged back at the US dollar, but it wasn't a complete peg exactly. They gave it a very tight band of places to move, which is why, since it was a soft peg, they were able to predict the next day it will trade between 6.8 and 6.9 versus the US dollar. Well, because they were controlling it on a very tight band of a soft peg. That's kind of how that works. So those are the basic three strategies that countries use in order to determine their currency policy. There are a couple other things I want to go over that aren't on this spectrum, but they're somewhat related. The first is dollarization. Some countries, they either have trouble with their own currency or because of instability in some way, they choose to do what's called dollarization. They actually make the US dollar their official currency for their country. All right, they outsource any monetary policy that they would do to the US Fed, and they just use the US dollar as their currency. They go float up and down on the free floating exchange, however the dollar does, because that is their policy. Another way that countries have a strategy is they merge their currency with other countries. For example, the euro, the Eastern Caribbean dollar, and some merged currencies are kind of top-down imposed, like France. Some of its former French colonies in Africa are on the CFA franc, which is actually printed in France but used by a number of nations that were former French colonies in Western and Central Africa. Now, a merged currency can still be free-floating exchange. It just has to happen in conjunction with all the other countries because it's only one currency. And if a country has dollarized, it's actually still free-floating exchange too, but they're not the country that has decided that. It's actually, they've outsourced that, in this case, to the United States, or in this case, to their other member states that own the currency together. Now, when you have currency exchange going on in the market, it's very complex. You have thousands of buyers, and thousands of sellers of every kind of currency, and the ones that are selling are trying to exchange it for a different kind of currency. There's no like set standard. A lot of students think, well, there's some set standard that's always the same, and that's what we go off of. It's actually always relative to everything else. So it's like I'm getting stronger compared to the US dollar. I'm getting weaker relative to the US dollar, something like that. So there's not any one fixed currency that's universal. It's just trading back and forth between different ones. Let's go ahead and simplify that process into something that is digestible, shall we? All right, suppose there are two countries, and we're going to call them Worley and Shirillia. They both print their own currencies. We have the Worley Wonder Cent, which we're going to denote with a W, and the Shirillia Chevron, which we're going to denote with a chevron. All right, and they're both on, let's suppose, free floating exchange. And this whole board here is the market. This is the current board. In my classes, this is how we do this. The current board represents this very moment, what is happening. Okay, so anything on here, if I put a W, that means one person in Worley is trying to sell their Wonder Cent in order to get some level of Shirillia chevrons, okay? So let's start out with an easy one. If we have one Wonder Cent and one chevron, what is the exchange rate? Well, it's 1 to 1. They are trading at what is called parity. This kind of parity does not mean a joke. It means that they are trading equally 1 to 1. Now let's make it more complicated. Let's say there are 2 Shirelia chevrons that are trying to purchase 1 Worley Wonder cent. That's going to mean, just thinking about it, that the Wonder cent is stronger than the chevron. So let's do some math with it. It's a basic fraction that you can do, and you can use your calculator to calculate the whole number and decimal when you do this. So let's make a fraction here. So we have 1 Wonder cent is trying to buy 2 Shirelia chevrons, right? And over here, we have 2 Shirelia chevrons trying to buy 1 Worley Wonder cent, okay? And here's a check. Here's a check for you. These fractions will always be reciprocal. The only time they're not going to be reciprocal is if they're trading at parity, because if you took away one of the chevrons, you'd be at 1 over 1 to 1 over 1. It would simplify to 1 over 1. So they're always going to be reciprocal. To translate that into what it's going to look like when you go into whole numbers and decimals, you're going to get one that is below 1, and one is that above 1, always and everywhere. Unless they're at parity, it's just going to be 1 and 1. So let's do the math here. You have 1 divided by 2, which is going to be 50.5. So 0.5, half of a Wonder cent, will buy a Shirelia chevron. Does that make sense? Yes, because they have to divide this into 2. It's only going to take half of a Wonder cent in order to buy it under these conditions. And then 2 over 1 is going to be 2. So it takes 2 of them to buy 1 of those. Not so bad. Let's try a harder example. Okay, now we have 3 Worley Wonder cents trying to buy 4 Shirelia chevrons, and simultaneously 4 Shirelia chevrons are trying to buy 3 Worley Wonder cents. So let's make our fraction. So 3 over 4, let's put that here, and then we have 4 over 3 here, and we check, make sure we're okay. Are they reciprocal? Absolutely. So 3 divided by 4 is going to end up being 0.75, and 4 over 3 is going to be 1.33 repeating, so we'll just truncate and call it 1.33. So it takes 1.33 chevrons to purchase a Wonder cent. It takes 75 hundredths of a Wonder cent in order to purchase a chevron. That's how it works. You notice what happened was, it looks like the Worley Wonder cent, compared to our last example, actually lost value, because now it takes more to buy a chevron, because more entered the market, but even more chevrons came onto the market. And so the Shirelia chevron there strengthened relative to the Worley Wonder cent. And that's how a free-floating exchange works. The market simply determines the price based on how many people are buying a particular other currency and how many of that other particular currency are buying that currency. That's as simple as it is. Let's move on to another example that's going to incorporate a peg. So one of these 2 countries, I haven't even decided which one yet, is going to do a hard peg against the other currency, and we'll see how that works in an operational sense. Let's start out and say there are 4 Shirelia chevrons and only 1 Worley Wonder cent in the market, and they're trying to buy each other. And let's say, Shirelia is actually up-and-coming country. They may be poor, but they're rapidly growing. They're converging with advanced industrialized nations, so they're rapidly growing. And because of that, a lot of people in Worley, which is already a developed country, they want to exchange money for Shirelia chevrons in order to invest in that country. So more and more people are flooding in order to buy these chevrons in order to invest in this fast-growing market. But let's say the government of Shirelia is like, we're just getting started. We're still kind of in a tender young phase in our convergence. We do not want our currency to become at parity, because it would be 1 over 1, 1 over 1. It would be at parity with this big industrialized economy. They're like, we're not ready for that. We preferred it when we were, only 1 on the board and they had 4 on the board. So we're going to have to do something because we don't want our currency to get stronger. So here's what they're going to do. I kind of shrunk our market down because I need to put something else over here. All right, so originally they had 4 here, and there was only 1 Worley Wonder cent, which would give them an exchange rate of 4 to 1, meaning it took 4 chevrons in order to purchase a Wonder cent, but now they're at parity. They want to go back to being at 4 to 1. So all these whirly wonder cents are flooding into the market. In order to purchase them, what can their government do in order to stop that flow of stuff coming in? Well, simply, they're going to have to print some additional chevrons. So their central bank will do this. They'll say, all right, we had normally 4, they had 1. We need to get rid of these 3. So I'm going to print from nowhere. The central bank can do that. They're just going to print money. They're going to print 3 chevrons, and they're going to deliver the chevrons over to whoever wanted them in Whirly, and they're going to go ahead and purchase these 3, the government will, and these 3 will go into something called Shirley's foreign reserves. A lot of countries hold foreign reserves, and often it's the US dollar they hold, but they hold other currencies as well. But in this case, Shirley has printed new money, satisfied the market demand, and they're pulling those 3 wonder cents that they just bought over here, and they're just going to store them in a nice little place, their foreign reserves. And what that does is that clears this market out, satisfies the demand, so you're not actually restricting the market any. There's still 1 here. But it satisfies the demand for the market, the demand for their currency, but they just expand their money supply and add anything they buy with it to their foreign reserves. Let's say it keeps happening. Well, let's do this. Well, real quick, they're going to print a chevron, do the same operation, and move that to their foreign reserves. As long as their currency is appreciating relative to the wonder cent, they can keep doing that. They can just print and print and print until they're all filled up, and they won't get filled up because you can have as much as you want in your foreign reserves. They can just keep buying the foreign currency in order to keep the value of theirs lower and peg it 4-to-1 to the Whirly wonder cent. That's how hard pegs work. Soft pegs work similar, except there's a limit to what they'll tolerate as far as the exchange rate. Well, so far, our currency in Shirley has been appreciating over and over and over. We keep adding to our foreign reserves, but let's say we fall into some hard economic times, we have a recession, and again, we still want that 4-to-1 exchange rate, but all of a sudden, our capital is trying to flow out of Shirley and into Whirly, which means more and more of our investors are saying, hey, gotta get our money out of Shirley. We're going to leave. Well, look at this. This is a disaster. We want to stay at 4-to-1, but all these 5 chevrons that are trying to leave, they're like, we can't have that because that's going to change our exchange rate from 4-to-1 to 9-to-1. We really, really, really don't want that. So is there anything we can do? Right here. Yes, there is. What we do in that instance when it's going the other direction is we say, okay, this is what we want. We want 1 of these to 4 of these. This is outside of what we wanted, and we can't print Whirly wonder cents to remove those from the market. We can't print them, but do we have any? Yes, we have them here. So there are 5. So let's take 5 Whirly wonder cents from our foreign reserves, buy up with those 5 our own currency, and then we hold our own currency in the foreign reserves, which doesn't mean much. It's not a foreign reserve then. We just hold that at our central bank, and we deduct that from our account here, and we're still left with the other Whirly wonder cents there. If it happens again, let's say this time there's 8. We just need to find 8. 1, 2, 3, 4, 5, 6, 7, 8. And these 4 go away, and we buy up our own currency to maintain it. And let's say it happens 2 more times. Happens 2 more times. And we have depleted our foreign reserves now. Now that we have no foreign reserves left, if it happens again, there's nothing more we can do. We have to accept the depreciation of our currency. So the one direction, when money's flowing into your country, you can always add to your foreign reserves doing a hard peg. But when it's flowing out, you are limited to the amount that's in your foreign reserves in order to stop it. If a country is going to be in trouble with, say, high inflation, or they're having some kind of crisis, you'll start to see their foreign reserves being drained. When you see their foreign reserves being drained, that's a signal for those who are in the currency trading business to kind of short that currency, and it actually accelerates that process, makes their foreign reserves drain faster, and then leads them to the crisis a little bit earlier than they would have been otherwise.